Hi, I'm Max Keiser. This is the Keiser Report. Things are happening. Secular changes, big changes, historic changes. Stacey.
And you know that's true because we have some charts. And we even have Mitch Firestein in the second half with some more charts. So the charts are, let's look at what the Fed has been doing and what the Fed is causing. And we have some interesting takes in the second half of this first half about what the Fed is doing. Taiwan Semiconductor is hiking chip prices up to 20%. TSMC's chips are in 1 billion products, including iPhones, computers, and cars. The Wall Street Journal writes in a new profile of the company. The company has slowly become the world's 11th most valuable company with a market cap of about $550 billion. The company's reported $17.6 billion in profits last year on revenues of about $45.5 billion. TSMC makes around 92% of the world's most sophisticated chips, the report adds.
They have a monopoly position. Now, what's interesting here is that microchips are, let's call it the steel of the 21st century. Steel was the primary component to build the Iron Age, to build modern infrastructure, the railway and tall buildings. But now, semiconductors are really the basic building block of our global economy. Now, here's the interesting bit. For 10, 15, 20, 25 years, the price of microchips has gone down and gone down drastically. And it goes down in a way that not everyone fully understands, because what happens is they get faster. And that faster chip, according to the inflation statisticians, means by definition how they calculate inflation, that inflation is low. And even if you pay the same amount, let's say $100 for a chip, if it's twice as fast, the Bureau of Labor Statistics in Washington, D.C. will say that inflation's falling 50% with microchips. Now, if this basic building block of the global economy is no longer on that asymptotic curve on a price point called zero, and in fact, you're going to start to see monopoly pricing and prices kick up. We know we had Jeff Booth on, for example. He wrote a book called The Price of Tomorrow about how the price of technology is dropping faster than they can print money, and that deflation is a permanent feature of the economy. This kind of belies that point a little bit and suggests that even microchips are prone to this type of disruptive malinvestments that come from too much money printing. And now we're having real inflation. And it's trickling through on so many different levels, so many different price points. And the central bank, because for them to admit there is inflation would mean they would have to raise rates and therefore put all of their friends on Wall Street out of business. They will continue the propaganda campaign by saying, no, there's no inflation. Don't believe the prices you're paying at the store. Believe us, there's no inflation. And this is catastrophic.
The Fed's role in the economy and making economic decisions, because the politicians themselves have actually abdicated any role in the economy or having any, plan for the future of the economy. But right now, with this article about semiconductor chips, you could see what happened. So in 1990, 37% of chips were made in the U.S., now 12%. Politicians are starting to notice this. They notice the supply chain disruptions, the chaos being caused across all sectors, from, Teslas to other auto manufacturers to a load of consumer electronic production. But in terms of what they can do about it, the Wall Street Journal points out that analysts aren't confident of there being a more diversified semiconductor supply chain, quote, anytime soon. They attribute this to TSMC's hard driving culture and deep pockets. The industry has become so complex that once one producer falls behind, it becomes tough to catch up. And I'm going to turn to some of the charts that the Wall Street Journal provides in this zero hedge coverage of the Wall Street Journal article. And it's called Chipping Away. Over the past few years, TSMC has increased its R&D spending and saw its market cap become the biggest in semiconductors. So you see TSMC is red and the blue line in the market cap is Samsung. Way down there, declining, ever declining, is Intel, which used to be the biggest of the manufacturers. But what have they done since the 90s? Hollowed out the company, right? Like all US companies, all US manufacturers use the opportunity of the China deflation move, of the export of our jobs there, to just hollow out the remnants of whatever was left of technology, innovation, and production here in the United States, and financialized it. So you could see that in the R&D numbers as well. The R&D is so crucial to anything, any manufacturer. You've got to invest in research and development. The US corporations aren't going to do that. Shareholders do not reward them for that. They do what the shareholders reward them for, and the shareholders reward them for stock buybacks and loading up the company with debt. So this is the stalemate. This is the situation where we find ourselves in today.
Right. Remember the Indiana Jones, where he's doing that swap in the under temple and the bag of sand for the gold, and then the boulder comes and chases him out. Right. This is essentially what Intel has done, and every major American corporation has done a swap, debt for equity. So they loaded up these companies with debt, and America's got the most indebted corporations in the world by a factor of incredible factor. And the equity, those hundreds of billions of dollars, was essentially stolen. I defy anyone to describe in any way how this was not theft. And now they're living large. You know, they'll happily take the hundreds of billions of dollars that they stole. And that carcass of a company, Intel, loaded with debt and no R&D, no CapEx, is withering on the vine. And now it's causing real inflation, and people have to eventually pay. So the money that was stolen by the executives by this debt for equity swap is now being paid by the consumer, who's going to see their quality of life collapse because all of the equity of American economy was stolen by a few people.
Well, we're going to cut to this next article, also from Zero Hedge, and it's a reprint of a letter from Eric Peters of One River Asset Management, who describes himself as a guy who used to work in the pits, you know, the trading pits in Chicago from 1989, and his observations of basically why we get these more and more unstable moments, these moments of huge market crashes because of stability, right? So the politicians intervened after 1978 and said, you know, during that whole inflationary period that we've talked about, looking like the 70s, the stagflation, and said the Fed has to have a mandate for full employment as well. So, you know, that resulted in investors kind of like for the next decade thinking like the Fed has everything under control, until it then suddenly didn't. And then he marks like where we are today with all this debt that you talk about, because everybody thinks the Fed has everything under control and will always step in. So every time now that the Fed steps in to, you know, fix a crash, it's causing the next crash to become way bigger, because everybody believes, all investors, and now every Robinhood trader, like everybody throughout the economy, believes that the Fed has their back. So it started, he said, in when US GDP in 1994 was 4%, unemployment was 5.5%, and inflation 2.7%. Greenspan hiked rates by 25 basis points to 3.25% in February of 1994. Employment gains had been on a tear, and yet somehow no one expected the rate hike. Naturally, he hadn't pre-signaled a change. He says naturally he hadn't pre-signaled because this was Greenspan's thing, his gobbledygook, his famous Fed speak. Nobody understood what he meant. He never signaled anything, like is now standard for the likes of Powell, Yellen, and Bernanke. They tell you, in 3 months, we're going to do this. Like they're always signaling. Well, Greenspan didn't. So naturally, he hadn't signaled a change. The bond market collapsed. Most people don't think bond markets can crash, but that's only because they haven't traded long enough to live through one. Like all crashes, that one happened for all sorts of complex reasons, but the biggest was that the system was highly leveraged to a certain future. So each interest rate cycle has been different over the course of decades, he says, but he points out that over the decades, the Fed has become more transparent, This transformation, he points out, was as a result of that 94 bond market crash that all agreed, whether the politicians, the media, or investors, that the Fed needed to be more transparent so as not to cause a bond market crash again. And so he says this transformation was well intended, seeking to reduce the risk of creating crises like the 94 crash. But as I guess as Nassim Taleb has quantified this in his book about black swans, is that the more stable a system becomes, the more fragile it becomes.
All right, well, 2 points, and the second one is about Hillary Clinton. The first point is moral hazard. So there's a concept in economics called moral hazard, and that is that if you constantly bail out the worst actors in the economy, they will act with immorality. And so what the Fed did is they've got moral hazard on steroids. They're rewarding the worst actors who are doing things like Intel and stealing hundreds of billions of dollars from people and destroying their own country. The second thing about the 93, 94 bond crash was that Hillary Clinton wanted to do universal health care, and Wall Street didn't like that. So Alan Greenspan very politically raised rates to crash the bond market, and Bill Clinton said when he comes back to life someday, if that ever happens, he wants to come back as the bond market because that has the most power of anyone in the world. So it was the politicalization of the Fed, and they would do it today, but with an interest rate at 0%, they are beyond the politicalization window. They're outside of that pale of the being political, and now they're in a trap of perpetual 0 to negative rates, and they're just waiting for the country essentially to go bankrupt. And those who can, like I was just reading how in Lebanon, people just have been leaving their country and putting their money into Switzerland while the country completely goes into the trash can. The U.S., exact same thing. You've got the top 1/10 of 1%. They're pulling it all out, and they're just watching the whole thing collapse like, Muhammad Ali and Foreman, just watching him collapse. It's a beautiful thing sometimes, decay and collapse, and that's the American elite. They want to see the country collapse just for the aesthetic of the horror of it because they're psychopaths.